Now that we've learned a little bit about inventory, we've discussed what the cost of inventory is, what cost of goods sold and the gross margin is. We're now going to dive into the perpetual inventory system. So this is the system that we are going to focus on in this course. In future courses, you would look more at periodic, but for this course, we will focus on the perpetual inventory system. And everything that there is to know in the chapter about perpetual will go through that, whereas periodic, there will only be a couple of things that I'll go through in the videos that you'll be responsible for. Okay, so the perpetual system, as just a reminder, this system keeps track of every piece of merchandise inventory. So whenever we have these purchases or sales of inventory, we always update our inventory account. Under the perpetual system, we always want that inventory up to date. So anytime we look at the ledger, we know how much inventory we've got. That is what goes on in the perpetual system. It's always up to date. So in order to make this happen, in the perpetual inventory system, all of the purchases plus any additional cost to get that inventory ready for sale, and the main one that we'll talk about is freight in. So purchases plus these additional costs, less any purchase returns or allowances or purchase discounts. These are all recorded through the inventory account when they are incurred. So we're going to look at examples of when we purchase this. We'll go through freight in and additional costs, and then we'll dive into what are purchase returns and allowances and what are purchase discounts. But the key thing here is that whenever we have these under the perpetual system, they will be recorded through the inventory account. And because we want our inventory account to always be updated, the way that we do that is by recording each of these items through that account. So we're always putting things through the inventory account for purchases in the perpetual system. So let's look at the first one here, how we record a purchase of the inventory. So the original invoice we get for that. So an example here says that on April 26th, ABC Company purchases $5,000 of inventory on account. So we need to record this entry. We are ABC Company, so we are doing this purchase. So what are we getting? Well, we're getting inventory. So we will debit the inventory account. We're adding in this $5,000 worth of inventory because we purchased that. And we purchased it on account. So like we've done in the past, we will credit accounts payable. So this isn't really new. Maybe we haven't directly seen anything go into the inventory account, but that's what we purchased. It's on account, so it goes through AP. We would say to record purchase of inventory on account. We'd also want to have our date here, April 26th. So we buy this inventory. So you would actually get an invoice from the supplier where you bought this inventory. It would show this $5,000 and therefore you would record it. So the purchase side is pretty basic. We got inventory, so we record it through that account. Now we'll move or skip down to this next section. So a purchase return and allowance. These are things that could happen after you've made a purchase of inventory. So purchase returns, these are when a business allows a customer to return unsuitable or damaged goods for a full refund. So we, right now, as we're looking through this, we're the purchaser. So if we buy some sort of inventory and it's not what we wanted or there's damage to it, we could return it to the supplier. They'd allow that and they would give us a full refund. So purchase returns, when a supplier allows a customer to return unsuitable or damaged goods. And this is for a full refund. So you give them the goods back and they give you a refund. So, I mean, you've done this, I'm sure, in your life. You've bought something, maybe some clothes, you changed your mind or they didn't fit, or an online purchase, you just didn't like it. So you send it back and you get this, you return it to the store where you bought it and you get a refund. Now, the second thing that could happen is what's called a purchase allowance. So in this case, the buyer, or us, the purchaser, we actually choose to keep the unsuitable or damaged goods, but we get an allowance or a reduction in price for that. So let's say we order some green coats we are going to sell these inventory items. So we purchase a bunch of green coats from a wholesaler, and when they arrive, it ends up that they sent us blue coats. So maybe we decide, well, we actually think we could sell these blue coats that are still pretty nice. Maybe we just ask for this allowance, a discount, since it's not what we actually ordered, but we're willing to keep those. So that is what an allowance is. So if the buyer chooses to keep the unsuitable or damaged goods, a reduction in price may be granted or may be given by the supplier. So obviously, if there's a severe amount of damage, the purchaser is not going to keep those. But if it's something minor and they're still able to either fix it up or sell it for a bit of a discount, they could be willing to keep it as long as they themselves get a discount from the supplier. So both returns and allowances, as it says at the bottom here, reduce the amount that is due to the seller. So if you either return something, you're not going to have to pay for it. You get a refund. Or if you get this allowance, a reduction in price, again, it decreases the amount that's due, assuming these are purchased on account. And because this means we are paying less as the purchaser, it reduces the cost for that inventory. And therefore, we also have a credit to the inventory account on the purchaser's books. So we're going to record this credit to bring down the cost of the goods because we either returned them or we got a reduction in the price. Okay, so let's look through an example of this. We'll continue on with the one we started with ABC Company. So this was what we originally booked as the purchase from April 26th. They had $5,000 that was purchased. We recorded it into inventory and it was on account, so we credited AP. Now we continue on, and on April 30th, ABC Company returns $800 worth of damaged goods. So again, we are ABC Company, so we're returning these goods to the supplier. So when we have a return, we've got our debit and our credit. So we're giving back these items. Therefore, we will credit the inventory account. So we gave them away, therefore we no longer have those sitting in our inventory. We need to decrease inventory with a credit. And because we've given them back, we're getting a full refund. So we also will have to pay less. Because we're paying less, we can decrease our accounts payable. So we also debit accounts payable for the $800. So we reduce the amount that we need to pay, which is our accounts payable, and we take it out of inventory because we don't have those items anymore. So this is under perpetual, and as we've said several times, perpetual, we're always updating our inventory. So since we got rid of these items, these damaged goods, we need to update our inventory, decrease it by that $800. Okay, then on May 1st, ABC Company, so that's us, we find one more item that is slightly damaged, just slightly damaged. We keep it in exchange for a $75 allowance. So we're keeping the inventory, but they're giving us the $75 reduction in price. So an allowance means a reduction in price. So again, we're going to say we debit accounts payable because we no longer have to pay the full amount. We just got this reduction in price by $75, so we get to debit our accounts payable to decrease this. And by giving us this reduction, it's also reducing the cost of the inventory. So now the amount that we purchased costs $75 less. So we credit our inventory account to show that decrease in the cost. Again, we're always updating our inventory account whenever there's a change. Here we had the reduced costs, so we are going to credit our inventory for that same amount. So both a purchase return and a purchase allowance, you will decrease your accounts payable and decrease your inventory. So we can quickly prepare a T account here to calculate what is the updated cost of this inventory that we've purchased. So the original amount in this purchase entry up here on April 26th, we debited $5,000. So that was the original purchase. Then on the 30th, we returned $800 worth of goods, and that was a credit. This was the return. And then the final one on May 1st, we had this allowance that we got. So we again credited this, but this was for the allowance or just the reduction in price. We still have those items. So we can calculate this, 5,000 minus 800 minus 75 gets us to this balance of 4,125. That is how much this inventory has cost now after the return and the allowance. Okay, the next thing that we will look at, next on the list here, are purchase discounts. And there's two types of discounts that you could see when you're purchasing something. The first is quantity discount, and the second is called a purchase discount. And just so that these videos stay a bit shorter, I'll hold off and I'll go ahead and talk about this in the next video.